Now, as I mentioned before, this isn't the last profitability figure. We also have to factor in those costs that are not directly involved with creating, selling, or manufacturing the product. And so we have certain indirect costs, if you will, or costs that aren't directly involved in the operations process. And so we look at operating expenses more specifically. And so we have two separate types. We have selling expenses and then obviously administration expenses. Now, first thing, a selling expense includes advertising expenditures. It also includes expenditures for sales staff. And so these individuals are not necessarily directly involved with producing the actual product. They don't create it, but they certainly have some level of involvement with regards to actually selling the product or service. And so they need to be compensated as a result because their time is used in the regular operation of the business, although they don't specifically create something. Now, with administration expenses, we're specifically addressing the expenses of general management. And so these are usually management salaries, can be maintenance costs, obviously not directly involved with producing goods and services, but they still provide some type of function. They provide an administrative function. So we have to obviously pay those individuals for their time in contributing to the organization. Now, adding up both selling expenses and administrative expenses, we actually get to total operating expenses down here, which we have $165,000 altogether. Now, if we take our gross profit, which is right here, and if we subtract our total operating expenses, which is here, we will get net operating income. And this is the money that we've received prior to taking into consideration interest as well as taxes that we have to pay. And all businesses have interest expenses as well as taxes that need to be paid out. And so the first thing here is we're going to take out our interest expenses. Now, where interest expenses are generated are typically from debt. And so just like if you and I had a mortgage or a car payment, we're going to pay a certain level of interest on that particular debt. So companies that go to credit unions and banks and actually get loans have to obviously pay interest on that debt. And so this is where that expense would be essentially included on the income statement because we're paying money out on a fairly regular basis as a way of continuing to meet our debt obligations and part of our contractual agreement with the lender. And so in this example, we have a debt or interest expense of $15,000. Now, factoring that out, obviously, from net operating income, we get taxable income, which is $160,000. And then, of course, we pay taxes on that, which usually is at a specified tax bracket. And so with $64,000 being attributed to taxes, we are left with a net income or profit, bottom line, whatever you want to refer to it as $96,000. And so at the end of this period, which is the entire year, ending December 31st, 2012, we generated $96,000 in profit. So after all of our expenses were paid, whether they're directly associated with producing the good or whether it's simply just operating expenses, taxes, and interest, that's the money that we were left over with. Now, a couple of things that should be included here that I didn't and I want to add now that we've gotten to this point, are we have to decide what to do with this $96,000. We have a couple of different options, of course. The first of which is we have to decide if we're going to pay what we call a dividend. Now, a dividend is simply a quarterly payment made to shareholders. And it's typically done on a per share basis. So, for example, McDonald's typically pays a quarterly dividend. They've done so for quite some time. And it, at least my last research of it, is roughly about 70 to 77 cents per share. And so the more shares that you own of McDonald's stock, they will essentially pay you anywhere from 70 to, I believe it's now 77 cents per share out on a quarterly payment, which is every, obviously, 3 months. So it's done 4 times every year. And that is meant simply as a way of rewarding shareholders for the investment. Now, there are 2 schools of thought. One, in which dividends provide a consistent stream of income that investors can expect. The other school of thought is that by paying a dividend, you're essentially stating that you really have no better use of the money to yourself. That's why you're paying it out. Rather, you should be investing it in the company. And so we can pay dividends, of course. That is certainly our right. One thing, though, is when companies typically start to pay them, they usually do not discontinue them because the market does not look very favorably upon that. We tend to believe that firms are in poor financial conditions when they do discontinue a dividend of some kind. So let's say that we actually paid a dividend. Let's say that we put about $40,000 going towards a dividend. We would reduce that from our net income of $96,000. And what that would leave us with is what we call a retained earnings of approximately $56,000. And retained earnings is money that the company keeps and it decides to reinvest it in the company. And so we're going to take that $56,000, we're going to essentially roll it over to the next period. And then we're going to have the opportunity to use that, whether it's putting it towards research and development, whether it is maybe using it towards different expenses, purchasing equipment, whatever the case is, that is money that we have at our disposal that we can certainly use for a later date. So there are certainly some similarities with the income statement and the balance sheet that I'm sure you've been able to catch up on here, but hopefully that gives you a good indication of what each of the different categories means, as well as some of the different elements that businesses will consider when crafting these types of statements.